Is researching stocks taking more time and effort than you want? Do you wish there was just a simple list to tell you which stocks to buy each month? Well, if so, I've got just the thing for you. Enter the Magic Formula Investing Stock Screener, which will select the top stocks for your investment portfolio. Or so they say. In this video, we'll break down everything you need to know about these types of stock screeners, including what are they, how do they work, the benefits of using these types of screeners, some of their drawbacks, how these screeners have performed against the market, and how you can effectively use them in your investment strategy. So when I'm talking about stock screeners, I'm not talking about the stock screeners that you can use on FinViz, for example. With those screeners, you select the fundamental and technical attributes to screen for and select only stocks that meet those characteristics. The screeners I'll be discussing are formulaic preset screeners that operate under a specific set of rules to select a list of stocks that they believe are the top stocks to buy. This is different from screeners that you can control because, unlike those, there's little or no input for you as a user. So before we get any further, what are these stock screeners exactly? In a nutshell, they're basically formulaic computer algorithms that take past data on each stock as well as their current price and apply that data to a specific set of rules for that stock screener. What differentiates stock screeners from actual human investors is that a stock screener, once those initial rules are set, is fully automated and requires no human interaction. Now, there are many different flavors of stock screeners based on different styles of investing. You have screeners for value stocks and growth stocks. You've got screeners for technical indicators as well as screeners for recent price momentum. In this case, while many of the characteristics of screeners I'll be discussing today can be applicable to all types of screeners, I'm going to be focusing on value screeners for this video. As our case study example, we'll be looking at one value stock screener in particular called the Magic Formula Investing Stock Screener. Now, this stock screener is actually the accompanying stock screener to the book The Little Blue Book That Beats the Market. Written by legendary investor Joel Greenblatt, this book and stock screener attempt to systemize the strategy of value investing that made Greenblatt so successful at his firm Gotham Capital. Using this investment strategy, he was able to achieve annualized returns of 40% for over 20 years. To put this in perspective, if you compound $1,000 at an average rate of 7% over 20 years, you'll be left with $3,870. Now, if you had invested in Joel Greenblatt's fund, that $1,000 would have compounded over 20 years to over $836,000, which is 220 times more than your $1,000 compounded at your average 7% rate. Obviously, these high pass returns increase the temptation to use stock screeners like this in hopes of achieving high returns in the future. However, in practice, do these stock screeners really provide the performance that they appear to be advertising? And how can you best use them in your investment decision-making process? In this case, we'll first go over how this stock screener would work in practice. Now, these are the recommended instructions for the Magic Formula Screener, but I've noticed that this is a very similar process to many other value stock screeners out there. What these screeners first do is they compile fundamental data on all these stocks, which include sales, earnings, assets, and liabilities, among other things. Combining this data with the current stock price, these screeners then apply a certain set of rules to value each stock based on certain fundamentals, and then apply a ranking the top stocks based on certain metrics of the screener. Now, the magic behind the formula is really based on two key components. The first variable is return on capital, which is used to determine how much money the company is making on the assets it owns. This is done by taking earnings before interest and taxes and dividing it by the sum of your fixed assets of the company and their working capital. The second variable used is called earnings yield, which is earnings before interest and taxes divided by the company's enterprise value, which is effectively its market capitalization plus any interest-bearing debt that it owes. These two fundamental metrics mimic most closely the strategy that Joel Greenblatt used to achieve market-beating performance over his investment career. Now, other screeners that look at growth, momentum, or other technical indicators might have a different rule set and thus rank stocks differently. In practice, once you have your set list of stocks that appear to be the highest ranked, the screener then suggests buying into those stocks either all at once or a few every month until you have enough stocks to be diversified. At that point, it recommends you hold on to the stocks for at least 1 year to take advantage of the long-term capital gains tax rate. After a year, you can sell the stocks and repeat the process again. So in practice, using these screeners is actually not that complicated, and there are a few additional benefits that can go along with using these screeners. One of the benefits is based on the inherent properties of a stock screener, which is that it's algorithmic and thus is a non-emotional way of investing. By using a stock screening investment strategy, you're limiting your chances of making an emotional mistake when investing. Another benefit is that once the strategy is implemented, it typically is a rather low maintenance strategy. With this value screener, once you have your initial set of stocks bought, you effectively then just wait a year to repeat the process again at that point. Those benefits being said, there are significant drawbacks to solely relying on a stock screener for your investment strategy. One potential drawback is that because of the nature of these screeners, they're based purely on past data. What this means in practice is that there's no adjustment made for future developments within a stock or a company. If new news comes out that could materially impact the future prospects of a stock, that is not going to be reflected in these stock screeners. Now, on the other hand, some may view this actually as a plus, as sometimes markets tend to overreact on current news. Either way, it's something that you should keep in mind. Another disadvantage is that these screeners may underperform the market and may do so by a significant margin. As with any investment strategy, there's no guarantee about future investment performance, even if they've had strong past results. In practice, significantly underperforming the market for an extended period of time could cause you to abandon the strategy prematurely. Many stock investment strategies depend on a long time horizon, so abandoning any strategy early may mean you're giving up long-term results. Alternatively, there is the very real possibility that the strategy that this screener is screening on is not a strong long-term strategy going forward. Some screeners you may encounter have limited history as to their performance, and some may not even have real historical performance, but simply back-tested performance. Another issue with stock screeners, which is maybe somewhat mitigated by using a value stock screener, is that some screeners lack a fundamental approach to screening stocks. What this means in practice is that many stocks that you're buying would lack a margin of safety to prevent against a permanent loss in capital. With some value stocks, there's typically a limit to which the price can only go so low before it becomes irrationally cheap. On the other hand, some stock screeners based purely on momentum might buy a stock simply because it just went up in the past. This could be in a stock that's losing money every year and is unlikely to be profitable anytime soon. Keep this in mind when you're thinking about using a stock screener in your investment process. Another drawback with these stock screeners is that some strategies may involve a lot of trading. If you're using a commission-free brokerage account like Robinhood, this isn't as much of an issue. Link in the description. But if you aren't using a commission-free brokerage or don't have access to one, then these strategies can add a significant amount of cost to you in the form of commissions. So what does this screener actually look like in practice? In this case, this screener has simply two criteria. One is the minimum market cap or size of the company you're looking at, and the other is the number of stocks you want in your list. In this case, with the default 50 million market cap and 30 number of stocks, we get what the screener believes are the top stocks out of all the stocks available to pick from. Now, if you'd rather focus more on larger capitalization stocks, you can adjust the minimum market cap as needed. In this case, it would end up filtering on larger, more established companies that you might feel more comfortable investing in. So the elephant in the room remains, do stock screeners like this offer a decent chance of outperforming the market? Of the performance data that I could find, it seems that the magic formula has performed exceptionally well in the past. In the case from 1988 to 2009, the magic formula produced a compound annual growth rate of just under 24%, compared to the annual growth rate of 9.5% from the S&P 500 in that same period. Over this time period, using the magic formula instead of the S&P 500 would have resulted in you having over 14 times more capital at the end of that period. However, despite its clear strong past performance, the magic formula hasn't been so magic as of late. While I was unable to find the exact details, there have been various reports stating that from around 2013 onward, that the magic formula has underperformed the markets. I'll link to a couple articles below that you can read further on your own time. On the recent underperformance, I think it's important to keep in mind that value strategies oftentimes will underperform during periods of extreme market growth and high valuations. Given that from a price to earnings perspective, there have only been 2 other times in histories where stock valuations are this high, one of them being 1929 and the other the dot-com bubble of 2000, I think it'd be reasonable to cut some value investing strategies a little bit of slack. If you're considering using a value stock screener like this, understand that it's best used for the long term. If you decide early on after a period of underperformance that it's simply not meeting your expectations, then relying solely on the stock screener is probably not the best move for you. With everything that we've discussed so far, I actually like this particular value stock screener, but I don't use it exclusively myself. The way I use it, and a way that you could use it too to help make more informed investment decisions, is use it as a way for generating ideas about stocks that you might be interested in looking into further. There are several stocks that have come up in this screener that I've looked at and found to be a compelling value proposition. Kroger and GameStop are 2 examples of stocks that have appeared in some value screeners that I've looked at. While their inclusion in these screeners wasn't my sole deciding factor when investing in these companies, having access to these screeners provides some insight onto stocks that might be worth a look in the future. If you made it to the end, thank you guys for watching all the way through. I hope this has helped get you a better idea of how to use these stock screeners most effectively and some of the limitations on using them going forward. If you have any questions, leave them in the comments and I'll get back to you. Until next time, thank you guys for watching, and I will see you in the next video.